slides. I call this toward aware and no harm investing, investment classification. And basically, what are the terms? I divide investments in 5 categories. Most of the investments we make are through intermediaries or mutual funds, and we're not really aware. So I call that unaware investing. There is the potential that those investments are extractive if you don't know what they're doing out there. Then there is aware investing. You know where the money is. No harm investing, positive and restorative. And then at the end, I will try to put in this context of this classification some of the other terminology that have been used for alternative types of investment. So let me start with unaware. The vast majority of investing, especially via mutual funds, ESG and SRI mutual funds and ETFs are a marginal improvement, but they mostly still fall under the rubric of unaware investing. If you have an ETF or an ESG, you might not be aware of all the elements, all the companies in that fund. Aware investing is usually if you buy a stock or a bond, you know where your money is. So if you buy shares of Apples, for example, your money is with Apple. So it's aware investing. Now, in order to practice aware investing, if you are using a mutual fund, you would need to know all the components and all the companies that are part of that mutual fund. This is a little bit hard to do. Now, no harm investing is an aware investing that also, as before, it requires full awareness and transparency to the ultimate component of one investment, and this is hard. Requires knowledge of no harm as opposed to lack of knowledge of harm. I told the story, for example, of Cisco, a company that is part of a lot of ESG mutual funds, and until recently, it was about 30% of its suppliers were practicing slave labor in Asia, for example. So it's hard to know exactly what those large multinational corporations are doing. So it's very hard to do no harm investing by investing in large publicly traded companies, in my view. Now, there are some traditional investments that could be considered no harm investing. For example, municipal bonds. We know what municipalities usually use the money for. Certificate of deposits of trusted financial institutions like credit unions or regional banks you're familiar with, and you know where they're lending the money and what they're investing in. Project-based bonds, peer-to-peer lending. There are a couple of platforms online like Prosper.com and LendingClub.com. I consider that no harm investing, mostly helping people getting out of credit card debt. And treasury securities and agency securities could be considered no harm. In general, you could say this is the government, we are the government, or at least we are we have the possibility of changing it. So one could consider U.S. treasury securities as no harm investments. Now, ESG funds belong, in my view, if you're basically screening individual stocks and bonds, you're certainly in the aware investing category. And I would have a special class called reduced harm. So if you're investing in ESG mutual funds or ETFs, you probably don't know what all the components are. So it's still unaware investing, but it's certainly reduced harm. So you're kicking out the worst offenders. Now, positive investing and restorative investing is, at the beginning, I used to call positive investing impact investing, but impact is a little bit too generic. So I wanted a new name for this type of investing. And it's basically a no harm investment that is creating a positive outcome, either environmentally or socially, in some situation, but in not all the situation. Some of the compensation, actually, in all situations, some of the compensation for risk comes in the form of social or environmental returns, and still has a positive risk-adjusted return. So after you adjust for the risk of loss, you still expect your capital back. Positive investments could either offer market rate return, or at times, positive investments may be concessionary. So you're providing capital at a rate that is maybe a little bit lower because you understand that part of the compensation for risk comes in terms of the things that you want to support either socially or environmentally. And finally, restorative investing. This is really at the intersection of investing and philanthropy, but is a very important aspect of this new type of investing, because if in the past capital has extracted from communities and ecosystems, we need restorative investing to put more money back into those systems than we want to take out. And so the primary or exclusive motivation for investing are non-financial. And I would call that return agnostic. You almost don't care whether you're going to see all your money back or what return you're going to get. It's very important to invest in something. An example recently that I invested in is Community Foods Market in West Oakland. And yes, I knew that the risks were high. And in fact, after a couple of years, they had to close down. But it was an investment to try to solve the problem of a food desert in West Oakland. Positively addresses a social or environmental problem, strongly relates to your personal values. And what distinguishes restorative investing from positive investing is that you actually expect a negative return after adjusting for the risk of loss. Like in the case of Community Foods Market, if everything went well, I would have gotten a 3% preferred dividend. There were more than 3% chance that the business would not succeed. So after adjusting for risk, it's a negative expected return and should be viewed really as a spending decision. So you should not invest in a restorative investment what you cannot lose. The best way to think about restorative investing is like a recoverable grant. You give this money to something you really care about. If they're successful, they return the capital to you. But if not, you don't see that as a problem. So this is basically the various types of investments. And if you just flip them, 90 degree, then you can map various other types of investing. For example, impact investing really is a broad spectrum. Sometimes you have impact ETFs. Well, you might not even know what all the components of that ETFs are. And yet it's called impact investing. So impact investing really could be anything in that spectrum. Local investing, in my view, is certainly aware and also no harm. And again, for example, Jenny is mentioning about this investment in Baltimore, right? That is a local investing. In this particular case, is a positive investment because it's trying to solve a problem, and you know where the money is, and it's doing no harm. Slow money investment also, I think, falls between no harm investing and restorative investing. Again, a Community Foods Market was a slow money investment in the restorative category. Community investing is the same. You know where the money is. They're trying to solve a problem, trying to grow the local economy. And finally, again, when we use the term social justice investing, it's very broad. I mean, there is a social justice ETF, right? There are maybe 800 names in that ETFs. If you don't know all the companies, then it's still unaware investing, in my view. But it could be positive. It could be no harm investing. Social movement investing also. It's interesting since they shy away from publicly traded companies. I think we are in the field of aware investing or better. And the same with regenerative investing is a term that has been very generic at this point. Now, when we talk about solidarity economy investing, I think this is squarely in the positive and restorative investing. So I hope this way of thinking about investments, unaware, possibly extractive, if you don't know where the money is, aware, you know where it is, no harm is you know where it is, and you have knowledge of no harm as opposed to lack of knowledge of harm, right? So obviously investing in a CD of a CDFI, for example, is a no harm investing or a positive investment. And restorative investment are the most speculative ones, usually startup companies, or, if you make a loan to a farmer, chances are that's a restorative investment, meaning a bad season could cause that farm not to be able to pay you back. And yet those loans are very important. So that's basically all I wanted to share in terms of this mapping of types of investing. And I hope this is helpful.